These are in listen-only mode.
Good morning, everyone. This is Mark Raymakers here with Insurance Agency Marketing Services. I'll be your host today with Kip Walker with Mutual Trust Life. I want to thank you for taking time here to join us this morning on this recorded webinar. So this is live now. We are recording it, so this will be available to you once the webinar has been completed. This is an opportunity for you, obviously, to see how Mutual Trust Life's product to Horizon Value can work in the infinite banking, or however you want to refer to it as. There's a lot of different names for it out there today. Insurance benefit concept, whatever it would be. We're also utilizing this product for college planning. And for some of you who are on here this morning, you're probably already getting set up to join us for that. We're going to have a two-day sales, or I should say training presentation on the college planning. If you're interested in that, you can certainly call and ask for myself. Again, my name is Mark Raymakers, and we can get you set up for that particular training. That will be next week. We're going to do it over a 2-day period, stretch it out a bit here. So I'll also point out that the question box is open. So as you have questions during the webinar this morning, you can certainly type in any question that you have, and we'll go ahead and address those as we go. Now, one thing about Insurance Agency Marketing Services, I do want to tell you that we always start our webinar off with some benefits and services that we provide to you, the provider. The one thing you're going to notice here is that there are a lot of different companies or IMOs out there that are offering products. And so what we want to do is we want to show you what we can do for you and what sets us apart. We know we've been in the business now for 31 years. And so just real quick here, I'm going to go ahead and introduce a few things too that we can do that'll help you out, and some things that are just ways of saying thank you. So first of all, we have a new producer bonus. And again, this is a way of saying thank you for your business by giving you some benefits for getting off and running here with us. First thing is, now we're going to talk about these different levels. They will be dollar for dollar on single premium life or annuities. If you look at traditional life, it's going to be a fraction. So maybe like $10,000 in target premium and then a multiple thereof throughout. So let's say you get to the 100,000 level. You have a choice between one of the three, which would be, of course, this is in addition to your commission, but a $750 cash bonus or a 2-year subscription to our website newsletter service. And the one thing about this is we can get this up and running for you in one business day. So if you don't have a website now, you want to get that up and running for your business, we can do that. You can either earn it or you can buy into it. It's a pretty simple program. Thirdly, there's the iPad. I know a lot of companies are going to the iPad where you don't have to worry about bringing forms. You can just do it electronically. So this is a great opportunity for you there. Now, if you want to wait to the next level, I can see where that would be of interest, because the full Social Security program with 3,000-piece postcard mailing has been very popular. What happens is you learn about the Social Security program, you do seminars, and it gives you an opportunity to sit in front of a lot more seniors, because obviously there's a lot of them retiring now, as you know. And this is a great way to generate additional sales for life and annuity. If you decide to forego that one, you could do the 2,000 matching mark, getting money to promote your business. There's a lot of great things we can do, and I'll show you some things here in just a moment. Or there's a $1,500 gift card. Maybe you just want to update your office there. You can buy new furniture with that. The last level is the 500,000 level. So if you're into seminar selling, maybe you've done it before, maybe you're looking at doing it, you know you're good at public speaking. These two gentlemen actually do a phenomenal job. I've seen their presentations. Matt Gill's a young guy who has a 5,000-piece mailing and seminar coaching. That's what he does, is seminar selling, does a phenomenal job at it. Qualifies for 3 to 4 different production trips a year based on his annuity and life premium. Or there's the 4,000-piece mailing and seminar coaching with Dave Pimper. Dave's very effective in his seminar approach as well. He does a lot of managed money, so there's a great bit of benefit to be learned from either one of those two. If you want to earn it, great. If not, you could always buy into it. You can call and ask for anyone in annuity marketing. They can help you with that. Lastly, there's a Ritz-Carlton Travel Rewards program. So maybe you just want to set up your own vacation. You can certainly do that. Now, here's something else that we do. I know a lot of advisors like to be rewarded with trips, and we've been doing these for a long time. We call ours the Top Producers Escape, and for 2018, we are working to qualify for the Boulders Resort and Spa in Scottsdale, Arizona. Beautiful location. This is for producer and guest. And you notice down in the bottom, it says qualify with any combination. So whatever you write with us, that goes towards that trip. And we basically look at a 2 million or $2 million or 2 million in points based on overall production. If it was just annuities, it'd be 2 million. Otherwise, you can see it's a portion or fraction of by product line. And so for today's purposes, we'll be looking more at the life target premium number. And so again, that is the qualification period is July 1st through December 31st of 2017. So there's been 18 months to qualify for that. Now, our creative services department, this is where if you wanted to take advantage of the $1,500 for marketing, as I mentioned in the new producer bonus, you could take advantage of any of these. So, for example, basic marketing. I know a lot of advisors and agents don't really have any kind of a brand, so they're not recognized. And so what we've done is we've helped a lot out there, a lot of producers such as yourself, to set up a brand. And it's really interesting how that actually helps your business because people start to recognize it. And it just really, I think it shows an extra level of professionalism, or maybe you've reached it. I'm saying you're branded, you've got a website. And then as far as taking it to the next level, we can go all the way up to television advertisements. We do recording of videos here in our office, or if you're at one of our training events, we can actually do some video work there as well because we have our crew that goes there for that. So if there's something that you wanted to do all the way up to television advertisements, we can help you with that. You can either earn those, or you can certainly buy into it as well. So this is a great way for you to do a lot more for your business, including going out and being on Facebook, the social media. There's definitely some benefit in doing that. So speaking of which, you'll see here, this is some of the stuff that our creative team can do for you. They can help you with the website. There's different client management tools that can help you with email newsletters. So there's a lot of things, if you're not taking advantage of today, they can help you with that. We are in such a high-tech environment. It's absolutely amazing what we can do these days. And so maybe you're a little intimidated by that. That's okay. Don't worry about it. Just call and ask for Josh in our office, and he can talk through some of the opportunities and things that he can do to help you on that side of your business. Now, we're real big on training. So what I want to do here real quick, what we do is you'll notice that when I talk about training, our webinar schedule is full. You'll see pretty much every day of the week there is a webinar of some kind. And so we do some offsite training. In fact, we're going to be hosting one this week. This is going to be in Des Moines at the Athene's office. And so I'm putting a poll out here real quick. What I want to do is I want to gauge your level of interest and then obviously reach out to you. But what we're doing here is we are going to, for this week and for the next two, we have one in September, and then I believe the other one is in early November. So what we do is we will fly you out on a Wednesday, so you'll be in the training. This week we're doing Des Moines. The next one we're going to do here in our office here in Omaha. Would love to have you come out. But what we'll do is we will fly you out here, so we pay for your airfare to get you here. That'll be on a Wednesday. We'll do some short presentations. We'll do a dinner, and then do an all day of training on Thursday and a half a day training on Friday, get you on a plane, get you back home. So we pay for your airfare. We pay for your meals. We pay for your lodging. There's no expense for you other than to be out of your office. So what I'm asking you is, if you're interested in any way in attending this event, and I'll tell you a little bit more here in a minute, I need you to mark yes. Okay, so with that said, if you mark yes, we will email you an application. We will email you an agenda so you know what we're covering. You'll be able to let us know your level of interest. And then if you can attend the one in September or then the one in November, we will let you know those dates and figure out which works best for you. So here's what we're doing. We are working on helping you to learn new sales techniques, new marketing approaches, learning new concepts on the annuity side and on the life side of your business. So what happens a lot of times, maybe you're just a one-trick pony, you sell just annuities, but you're leaving money on the table. So this is going to help you to figure out how to incorporate life insurance sales into your annuity sales. Or maybe you're just selling life insurance and you want to also offer annuities. So what this does is we're going to train you on a lot of different sales ideas and concepts. There'll be some seminar stuff. In fact, Dave Pimper and Matt Gill will be at these events. I mentioned as a new producer bonus, you can actually get a look at what their presentation is like. Not only that, but there's a lot of networking. The nice thing is you're going to be with top advisors from across the country. It's an opportunity for you to hear it's working for them. I will tell you, I've been in this business since '88. Some of the best sales and marketing ideas I've ever heard were sitting and listening to some of these top advisors that come in from across the country. Speaking of which, we also bring speakers in from across the country. They're not just IAMS employees. They are speakers from across the country, training and telling about their most successful sales approaches. So again, I'm only seeing half of you had voted in on this. If you're not receiving training today from your agency manager or from your current IMO, whomever that would be, I believe you're missing the boat. In my experience of being in this business as long as I have, the most successful agents and advisors in this business are always learning something new. And it really truly is amazing, because I know our top 50 agents and I can see why they're so successful, because they're always trying to find out something new that they can incorporate in their business to help their clients. There's product changes, there's riders that are coming up that have never been available before. And these are great ways to benefit all of your clients one way or another. So this is your chance to get training free on us. Okay, I've got about 60% of you voted. I'm going to go ahead and I'm going to close the poll. If you decide that you want to learn more about it, just because you say yes doesn't mean you're committed to it. We'll let you know the dates, we'll get you an agenda, etc. All right, so if you decide you want to get more information, just call our office, the 800-255-5055. Okay, let's go ahead and move on real quick. So this is real simple to get contract with our carriers. We email you a document, you fill it out, and once you fill that out, it pretty much covers getting contract for any carrier we do business with. Now, there's some, Mutual Trust Life will have to have you sign a separate document for them, but it's easy for you, because let's say that you call in and say, hey, Mark, I need an illustration for this carrier, or I want to add an annuity carrier. All we have to do is you don't have to worry about it. We'll go ahead and we'll get the information over to the company, and they'll go ahead and appoint you with no further paperwork that needs to be signed. So you can certainly go onto our website and obtain this, or at the end of the webinar, I can email it over to you as well. And our web address is www.imsinc.com. Everything you could possibly imagine is available for you. We've got it set up, obviously, to where if you need quotes, you want to check into product information and details. Maybe you need an application. Maybe you want to fill out a contract for a carrier, however you want to do it. But all the forms are there. So maybe you call into our office after hours or on the weekends. I know when I was in the business, I worked every day of the week. I periodically had to squeeze in a Sunday. So maybe you're working on any one of these days that we're not open. You can pull anything you need from the website there. So I'd encourage you to go and check that out. And then, of course, if you have any questions, you can always call our office. So here's something that we've done real quick here. The Department of Labor has really changed, or is in the process of changing the way we do things. And so what we've done is we've opened our own RIA. So the nice thing about this is it's an opportunity for you to be a one-stop shop for all of your clients. It allows you the opportunity to work on managing money for your clients, which obviously it's a new revenue source for you. Maybe you're considering taking your 65. We will financially help you to do that. We can support you on that side. And I will tell you that you will see an increase in your revenue in your business, because it gives you it's like another leg to that stool to help your clients. Maybe they want to be a little bit more aggressive in their investments than just an annuity. It helps you with that. It also helps improve client retention. So what happens is the more lines of business, whether it's life, annuities, it's managed money, it's long-term care, MedSup, whatever it is, the more you have with your client, the more likely they are to stay with you, which is a good thing, because that just bumps your revenue up. Again, it really does help strengthen those client relationships. So if you want to know about it, in fact, I'm going to do this real quick here. I'm going to put out a real fast poll, because what I will do is, if you're interested in knowing more, just mark yes real quick. And what I'll do is I'll have one of our guys from our IAMS Wealth Management team give you a call. They can talk to you about taking this Series 65. They'll talk to you about how we reimburse you for that. We had one training event here. We're going to be having another one. I'm not certain exactly when that's going to be. It'll probably be within the next quarter. So if you're interested in knowing more about IAMS Wealth Management, just mark yes. I'll have one of our guys give you a call, and just see if we can help add that to what you're doing. This Series 65 is a tough test. There's no doubt about that. But when you look at all the benefits and the opportunities that are out there for you by getting that license, you most certainly will see that. And the other thing too that I've seen and heard is where maybe you've got a friend who's in the business and they're just plain and simply not going to take the series exam. They're not going to handle manage money. I've seen a lot of referrals. Before I got mine, I had to refer business over. I said, I'm tired of leaving money on the table. So I went out and I took my exam and I started managing money myself. So again, it's an opportunity for you, and maybe some of your buddies out there aren't going to take that step. So maybe they'll refer business over to you as well. Okay, so tremendous response. I appreciate that. So what we'll do is we'll have one of the gentlemen on the IAMS Wealth Management team here give you a call. I'm going to go ahead and close the poll. And, if you decide that you want to give them a call, maybe take down this number. It's 888-255-7670. And then they'll give you a call there. Okay, real quick tool that I think you should consider looking at. If you're not using something now to help in the advisory process, to look at the Retirement Analyzer software program. That's something here, if you're interested, you can call and ask for one of our gentlemen or ladies in the annuity department. They can get you the software here. It's a great way for you to do a holistic planning approach. And it helps show your clients how close, how short they are to reaching their retirement goals, and it helps to reposition and do a better job of advising for them, and it will generate more sales, I guarantee you that. This is for the computer-savvy individual. If you're having trouble finding the on-off button on your computer, this isn't going to be something that will probably benefit you. But if you're real comfortable with maneuvering around on a computer and working on spreadsheets and things like that, it's a super program. Okay, one last thing from me, and then I'll turn it over to Kip. So we have something we call a referred producer program. And just like you like referrals. So let's just say, for example, you have some friends in the field. Maybe here I'm asking you, do you have a product like this? Or, I'm not getting this kind of support, or whatever it is. Maybe they are happy with where they're at, but there might be something that they're leaving behind, an opportunity they're leaving on the table. If you refer anyone to us that's in this business and they get contracted, we're going to send you a check for $50. And then what we're going to do is we are going to send you a check every quarter for their production. Now, they're not taking a commission hit. You're not in the commission business. This is simply a way of saying thank you for the referral. And this has been a great program for us. We have agents that are collecting over $10,000 a year because of the agents that they refer over, and they are completely free and clear of it. They're still friends. There's just no tie there other than it's a referral bonus for you. So if you think of anybody that might be a good fit, a good person to refer over, call and ask your marketer, or just call and ask anyone here in the marketing department. Tell them that you've got a referral, and we'll get them set up and get those checks start to flow your way. Then we have our marketing reimbursement. One last thing, this is something that I really like. I know that when I was in the field, expenses are just out of control, and it seems like all you're doing is you're working to pay the tax man, right? So this is a nice way for you to help offset the costs of all of your expenses. So what we do is, let's just say, for example, you write a $100,000 annuity, you write a $100,000 single premium life, you write a $10,000 target case. We're going to put $200 into a marketing reimbursement program for you. And let's say that you're going to do a seminar here in June. You spend $1,000. You send us a receipt. We are going to send you a check for $500. So in other words, we reimburse you up to 50% of whatever your marketing expenses are. It could be something as simple as having a customer appreciation picnic over the summer. I've seen those before. We have an agent in the fall who does a customer appreciation, and he spends almost $50,000, and he saves up his marketing reimbursement dollars all year long and uses that to reimburse him. So his $50,000 now is cut in half, and it is an amazing customer appreciation. I went and spoke at it here last year. Unbelievable. I mean, he had a band. They gave away a cruise. They gave away a trip to Las Vegas. I mean, just so anything you can think of that's going to help you to grow your business, or maybe just help offset your expenses, this is something that we'll do for you in addition to your commissions. So certainly remember that when you get contracted with us here. And then if you have any questions, you can certainly call and ask for anyone in the marketing department. They can explain it or help you with that. So that's pretty much going to take, that's all that I have at this point. So Kip, are you with us?
Yeah, I'm here, Mark.
Great. Okay, so I'm going to go ahead and turn it over to you. I assume that you've got your PowerPoint up. So I'm going to give you control here. Thank you again, Kip, for taking time to help us out here this morning.
Oh, you bet. It's always a pleasure. I appreciate you letting me speak.
You bet.
All right, well, I'll go ahead and get started here. Thanks again. As I said, it's always a pleasure working with you, Mark, and your group, and all the great things that you do in training and support. It's right in line with how we like to operate. And one of those systems that we align with to help do that is the infinite banking concept. It's a very powerful system. We've done these presentations several times now, haven't we, Mark? And we have a couple that we have been focusing on, and this is the second part in that series. So hopefully you are somewhat familiar with the infinite banking concept. If you're not, this will still be beneficial for you, but this is more of a nuts and bolts type of discussion that we're going to go through. I'm going to go into a little bit of spreadsheets and illustrations and kind of explain to you what is going on. How does the infinite banking concept actually work? Why is it so powerful? And so I will go ahead and get started right now, since it's a lot of stuff to take in, but we can do it in a pretty short amount of time to get the gist of what's happening. Take notes, ask questions. If you think of anybody that you think might fit this concept as we talk a little bit about the profile, please write those names down, contact Mark, and we can get together and see if we can do something for your clients. Obviously, this is going to look good, but none of this is going to matter if we can't make it work for you. So hopefully you take advantage of what we talk about today. So we're going to talk about whole life, why it works, the structure, the cash value accumulation, how policy loans work, and I don't know if we'll get to IBC sinking fund, but that's okay. We don't need to. We are going to answer why whole life. How does IBC work? Why IBC? Why do it at all? Can it be illustrated? And then how do policy loans work? So why whole life? Guarantees and growth continue when the cash value is accessed through policy loans. So one of the, I would say, three or four primary aspects of IBC that make it so powerful is, one, the power to collateralize, and how important that is. And you need to be able to collateralize money, and you need to know what you're going to get when you do collateralize. So it has to be something you can count on and being there, and you need to be able to access it. So that's why whole life works so well with this concept, because when we talk about the clients that we are working with, we're looking for individuals with a substantial household income. I mean, $70,000 and up, families, business owners. This money that they are using in this particular situation, it needs to be guaranteed. You need to be able to access to it, but it needs to be guaranteed. This is money that we are taking from a traditional bank savings account and moving it into an IBC bank, which it's basically moving money from one financial institution, a bank, to another financial institution, a life insurance carrier. It just so happens that we have a life insurance carrier, Mutual Trust in particular, has a product that can really more efficiently do what they want to accomplish. All right, these individuals are trying to build their wealth. They care about their family. All right, that's very important as well. So what we're doing is we are taking an account that is liquid and has guarantees and can be collateralized, and that's very important. So that's why whole life works, that guaranteed growth that can be collateralized. Now, the other thing is taxes. Collateralizing is so important because it doesn't interrupt compounding. You take an asset that's earning 2, 3, 4, 5, 6%, you collateralize it, and you let it continue to grow and compound. Because if you interrupt that compounding, you have to start all over again. All right, so that's why compounding is so important, collateralizing is so important. But also taxes. You want to let that asset compound and grow in the best environment possible. And taxes will impede that growth. With whole life, with properly structured whole life contract, that money compounds and grows income tax free with no impediment from taxes, which can be anywhere, as you know, from zero, I guess, if you do some things right, but up to 38% right now. They're talking about bringing it down to 35. So that's a lot of money to redirect into the client's pocket. And what we've talked about in previous presentations is that it's not just the 35%, it's the whatever percent interest rate they could have earned compounded annually on top of that 35% tax bracket. So it's much more effective and efficient when you can just take taxes out of the equation altogether. And then the great thing is when the client is ready, if they want to, they can turn off the premiums and start taking distributions, and then they have a whole another pool of income tax-free capital they can access to bolster their retirement and their legacy. So these contractual and legal rules that whole life insurance works within, provided, and the guarantees it provides, are why this works so well. So how does it work? Well, we're using the infinite banking concept, as we discussed previously, for purchases that cannot be made out of your monthly income. So we're not using this concept to pay your monthly bills that you would pay out of your pocket anyway, your electric bill, going to the grocery store, things like that. Clients are using this money, this pool of capital, for things like buying a new car. Maybe they like the smell of leather every 5 years, and they want a new car every 5 years. Or maybe they want to expand their business. Or maybe there's an investment opportunity that they can comfortably get 8% on or 10% on, but they need access to capital to take advantage of it. Okay? Now, we know that many individuals will go and get a line of credit, maybe a small business administration loan, anywhere between 6.25% and 8%, depending on how much and how long. It'll show up on a credit report, and if they miss a payment, they could get in trouble. Or they'll take a line of credit out against their house. Some will save up money in a savings account, and so that's the traditional way of doing it. But each of those has their advantages and disadvantages. And the primary disadvantage is it's really difficult to build your wealth with those strategies. If you're a pure, borrower, you're just going below the zero line. You have no assets, and you go below the zero line, and then you try to make your payments back until you get back to the zero line, and then try to save what's left, maybe 5% of your income. All right, it's a very inefficient way to do it. Maybe you have a savings account. You build up $10,000 in the savings account, then you draw it back down to zero. You're never getting ahead. Many clients will, many of us, just human nature, we will save the money up, take it out, and put it back in, but we rarely put the interest back that it would have earned. And I don't know of anybody who puts the interest back on top of the interest. So this is a very effective way, a very efficient way to build up your nest egg, build up your pool of capital without interruption. Take advantage of it without interrupting the compounding. Pay it back and put yourself in a better position than you were before you took the loan. Okay, so it works through again, the efficiency of collateralization in an income tax-free environment, and puts the client in a position of strength as far as loan rates, what rates they're going to pay, what rates they're going to be charged, where they're going to get their loan. It's a great asset to do this. So why IBC? Well, I think I pretty much said that. What we're trying to do is we're recapturing interest on loan payments that we made to traditional finance companies. We're redirecting those back into our own pocket. If I put money into a bank and it's earning, let's just say 2%, the bank is going to turn around and lend it out at, let's say, 6%. So many of our clients will think, oh, well, they're making 4% on my money. No, they're making a 300% markup on your money, because they're taking other people's money, marking it up 300%, and then lending it out. And what we can do is we can use that same strategy. It's not as leveraged because they're using other people's money. In this case, we're using more of our own. But it still is effective, because what you can do is act as the wholesaler. Insurance company loan rates tend to be lower than other rates, and they are guaranteed. So you can just get the loan. It doesn't show up on a credit report. You don't have to qualify with your income. The cash is there. You send in a one-page request to Mutual Trust. You get your check in 2 or 3 days. The loan rate is 5% currently, And in normal interest rate environments, the gap between retail rates and what you can get, other retail rates and what you can get against your policy loan tend to be bigger. So right now, as I mentioned before, SBA loan, it can go up to about 8%. Let's say that's your best alternative. If you had never heard of infinite banking and you never set up a policy, you're gonna get that loan at 8% if you didn't have this pool of capital. Let's take the loan against our policy at 5%. All right, we're the smart banker. We're going to take our loan against our policy at 5%, but instead of paying it back at the 5%, we're going to act as a wholesaler, and we're going to recapture some of that interest that we would have paid to that other bank where they would have marked, where they're getting their 300% markup. We're going to redirect that money into our own pocket. And so instead of paying back at 5%, we're paying back at 8%. Those additional 3 percentage points go back into our policy and build up the cash value, build up the death benefit, and all the other benefits that come with it. And you think, well, that's 3 percentage points. Well, no, it's 25 to 50% of your interest being redirected back into your own pocket. It's not just 3 percentage points. So we have to think in those terms. And so that's why we want to do IBC, because we are taking money back from those financial institutions and we are putting it in our own pocket and building our own wealth with additional benefits on top of it.
Hey, Kip.
Yes.
Do you have time for a quick question?
Absolutely.
So Bob is asking, how long before a loan can be taken against a policy, and is it a fixed or variable rate?
That's a great question. So the loan can be taken as soon as the cash settles in the policy. It's we say 10 days, but it's a matter of how quickly the checks are cashed and all that. So yeah, there is no artificial limit. 10 days within the date of the policy getting set up is typical. As far as the loan interest rate, it is a variable. We have a cash value. It's calculated as a cash value rate plus 1%. So what that means is, right now, the guaranteed rate is 4%, and our loan rate is 5%, and that's what we've done throughout history. So we need to recoup some of that money that we're not earning in investments, and so to do that, we add a 1%. However, we do have the dividend on top of that, so the net difference tends to be anywhere from a little less than 1% to 1%. So it could be even a little bit better than that, but it is variable. Again, it's either the cash value rate plus 1% or the Moody's Bond Index plus 1%.
Thank you.
Mm-hmm. So can it be illustrated? Yes, it can. And we have a special module set up in our software, our illustration software called Century 2. And within that Century 2 software, there's an insurance benefit concept module. We don't expect you to jump in and just know how to do these. We will run these cases for you and with you and explain to you how it's working and what we can do for your client and whether it will even work for them. We're not going to try and make this fit where it doesn't. But you can absolutely illustrate, and we're going to take a look at some of these illustrations here in a minute. How do policy loans work? So there's a misconception that when you take a loan, it's coming out of the policy's cash value, and that's why the client thinks, well, I'm borrowing my own money. But that's not at all what's happening. What's happening is the money stays in the policy, the cash value continues to grow at the guaranteed rate, plus dividends to a varying degree, and we'll take a look at that too. And the money comes from the general funds. It's just like if you have a savings account at a bank and you pledge that savings account to the bank as collateral, and then the bank gives you a loan. It's the same idea. It's just that instead of using a savings account at a bank, we're doing something much, much better. We're collateralizing an asset in an income tax-free environment that has additional benefits, and plus you can get the loan guaranteed without going through any of the other requirements and red tape that a bank requires you to do. Plus, you can generally collateralize more of the money. We can collateralize up to 95% of the cash value. With a bank, sometimes they maximize it at 50%. You can't take any more than 50% against your collateral. So we don't have those other restrictions and drawbacks. So that's how it works. The policy loan comes out of the general account, not the policy, stays in the policy and continues to grow 4% to support all those other benefits that you have. So let's take a look now at actually how that works and what that looks like. So I'm going to switch over here and show you a couple of spreadsheets. And I know it's fun to look at spreadsheets, but I'm going to try and limit it to just what we are, just enough to get the point across here. So let's first take a look at, I'm going to try to find, okay. So we're going to assume we have a client that has $18,000 to work with. All right, this is a male, 45 in this case, and we're working with $18,000. And the traditional, method or investment philosophy is to buy term, invest the difference. And let's say that they have a need for about a 1.3 million in this case, death benefit. They actually want to get as much as they can, but we're looking at 1.3 million in this case. And what he's going to do is, in the traditional investment philosophy, is take his $18,000. He's going to buy term. It's going to cost $22.30 in this case. You could find it cheaper elsewhere. And he's going to invest the remaining $14,800 in a CD, or other investments. And so what that puts them in is a position of risk, because if even if they invested it in a CD that's it's perfectly safe, and we're actually putting the whole 18,000 in this particular look at it, and he's investing it. He's investing 18,000 in a CD. He's got a 25% tax bracket, and he's earning 2% on that money. Maybe he would invest it in something more risky, and get a higher rate of interest. But let's just look at safe money right now. Okay, safe guaranteed money. He ends up, because of the tax rate and putting the full 18,000 in, he ends up with $685,000. Now, that would be the safer way to go and be less risky than investing in muni bonds or equities, real estate, and other investments along those lines. But this would be more safe than that. But even if he does this, he's still at the end, he's going to have $685,000. At the end of the 30 years, that term that he has paid into for 30 years and spent $66,000 on, it's going to go away. And he's going to be age 70 at this point, 70 plus. And that additional $500,000 of income tax-free funds will no longer be there to go to his children or grandchildren. And now he's left, so he's missing part of his legacy, just went away. He has a nice chunk of change here, $685,000, but he has to balance living on this money versus how much he's going to give to his heirs. And so, this is the typical kind of scenario that we're looking at. So let's take a look at doing putting $18,000 into a whole life contract. Just no loans, no infinite banking going on. After 30 years, so this is the same male, 18,000 going in, and he has he starts out with a little lower death benefit. Okay, and maybe we would want to buy some term for a little while to make sure that he has enough, or maybe we wouldn't split it quite this way. We would give him a little more term to make sure that he has enough coverage and put a little less into the policy. But by the time he gets to the point where he really likely is going to want to rely on that death benefit, it's going to be there and it's going to be guaranteed. And with the return that he's getting, he has $814,674 in cash value. So we're getting a little bit of better rate of return because we're including the dividends in there. And he has a death benefit that's never going to go away. If he gets sick, there's a chronic illness rider on here that allows him to accelerate 24% of $1 million every year until it's depleted, if he needs to, or he can take less than that, just takes what he needs. So if he gets to the point where he's about to retire, or a few years before retirement, and he can't work, what's that going to do to his buy term invest the difference plan? Is he going to be able to continue to build his plan, or is he going to have to take so much from his nest egg that he's going to blow up his whole plan for retirement? This puts a buffer under all of that. And that's just talking about the policy and putting it in place and some of the benefits that it provides. Creditor protection, depending on your state, gross income tax free, it could be excess income tax free. Death benefit that never goes away. All right, so those are the benefits. Now let's put this whole idea on steroids and introduce the infinite banking concept into it. So he takes a loan. Now he's taking loans. He's implementing the infinite banking concept, and so he's a business owner who needs, let's say, $30,000 every 6 years in this case. He's taking those loans out, or every 5 years, sorry. He's taking those loans out and he's paying them back. And, obviously somebody's not going to take loans like this every single time for the exact same amount. It's going to vary, but this gets the point across. He's taking the loans out, and then it turns out that the next best rate he could get is 10%. All right, that's just, we're assuming that is the best he could do. All right, so instead of taking the loan out at 5%, which he's getting from us, the carrier, he is taking the loan out at 5%, but he's very smart, so he's paying himself back at the 10% rate. That was the next best rate he could have possibly gotten. He's feeding that interest into the policy, and it's going in through what's called the paid up additions rider. Okay, so the paid up additions rider is actually part of the premium, and it's the very flexible cash rich part of this premium. And with ours, you can put a paid up additions rider on top of a base, and it doesn't matter what the size of the base is. You just need to, you're underwritten one time up front, and you can put up to $100,000 every year into this PUA rider, subject to financial approval. And as long as you make that $100 minimum payment, it stays active, and you can contribute anywhere from $100 to your maximum. And you can build these PUA riders to be funded at a lower level, but with the ability to take more money later when you have additional money to put in. So that's how we designed this one. This is an $18,000 total premium. And you have, let's take a look at the build actually on this. So in this one, you have, of the 18,000, 7,300 roughly is going to base, 10,700 is going into the PUA rider. And again, they can vary how much they want to put in, anywhere from $100 up to the full 10,701. They can send the money in anytime they want, doesn't matter, as often as they want. And so it has a great degree of flexibility. So what we're doing then is, when we pay our loan back, that additional 5 percentage points that we would have paid to that other financial institution is being redirected back into our policy through that paid up additions rider. And that's why you see the premium go up by $547. That's PUA money going into your contract. So now, by implementing the infinite banking concept and using it, the more you use it, the greater it is, but you only want to use it when you really need to. But the more you have advantage, take the advantage to use it, the greater the cash buildup will be. So now, where we had a cash value of we have a cash value buildup of $824,000 by the end of 30 years. And when we took no loans at all, we just had the policy in force, never used it, didn't take advantage of those other benefits that you have, and the ability to, implement the infinite banking concept. We have more than about $10,000 more than before, just by utilizing those, taking those loans out. Trying to get the highlight for me there. There you go. So we have about $10,000 more than it would have, and that's with taking the loans out. So the money continues to grow. We don't interrupt the compounding. All right, the compounding continues to move forward, and it even comes out stronger in the end because we took out loans as the honest banker. We paid them back at the retail rate, the next best rate we could have gotten had we never heard of the infinite banking concept. So on top of that, now you have an asset here that you can draw on income tax free in retirement once we shut off the premiums, which we can certainly do. You can take those distributions strategically. Maybe you have other investments that are more risky. And that's really what another thing this allows you to do. This frees you up and gives you permission to take the additional risk in equities, in real estate, in other investments, other business opportunities. This gives you permission to do those things and feel better about it and be in a better position, because if things don't go well, you have this asset, this powerful asset that is buffering and supplementing your entire financial plan. And so now if your asset that you're drawing from for retirement takes a hit, maybe the equity market takes a hit, and you're going along in retirement taking your 4% rule of thumb distribution, and now you don't have to take that 4% distribution from a depressed asset. You can let that asset build back up. Take the money from your compounding asset that's going up every single year and let the other asset recover, because you don't want to take a distribution from a depressed asset that has to then work even harder to get back to where it was before. All right, so, and we know that this money is going to be here, again, because of the guarantees that whole life has. You could pay the premium on a whole life contract in the grace period every single year of the contract and never lose any of the guarantees. I mean, the guarantees are just unparalleled. So that's basically nuts and bolts how this works. And so when we were looking at kind of a buy term invest the difference comparison here, you have cash values at different periods of time on a standard policy, and then a standard properly built IBC policy with no loans, and then standard interest paid, and then extra interest being that instead of paying back the 5% that mutual trust charges, you pay back whatever the other financial institution would have charged you had you never heard of infinite banking. That's what that means. So there's a table showing what those values look like. They with no loans, you do have, let's address this right now, direct recognition. We are direct recognition. So with no loans, you're going to have a little bit more cash value showing up when you factor in the dividends, because we do use a factor of 0.007 against any average outstanding loan balance. So what that means is, let's say you take a loan for $20,000, you pay back $10,000 over the course of the year. Your average outstanding loan, therefore, is $10,000. We're going to multiply that times 0.007, which is, I think, about $70. And then if you were going to get a dividend of $500, we're going to subtract $500 from your dividend. That's direct recognition. As you can see in this scenario where we're taking a lot of loans and paying them back over a long period of time, after 30 years, the impact was about $5,000. So, not a huge impact on what has really been a sticking point for a lot of individuals out there who really aren't familiar with IBC and really all the many of the details. You have to think about what else goes into it. What's the interest rate that's being charged? Is it 5, 6, 7, 8% versus direct versus non-direct? Does the carrier even like to do this type of business? We've had many carriers that will tell our agents, yeah, we'll take your IBC business, but what they really mean is they'll take an app. And then once loans requests start coming in, and they come in a high volume, they start pushing back. And so we've heard this many, many times. So you have to factor in all of the benefits out there versus the drawback of us being direct recognition. And the reason we do that is because we build our business based on equitable treatment of people, fair treatment. And so if you're taking a loan, we need to recoup from those who are taking loans. We've set this up also in a way that's sustainable for us as a company. We have to be able to do this business and do it right. And so direct recognition ensures that we can do that. And again, with minimal impact. And when you really implement the infinite banking concept to its full extent, put it on steroids by repaying those loans back at the rate the client would have been charged, you can see that they still come out ahead. Okay, so that's direct versus non-direct recognition, and not a big deal in most cases. So we compare this to our buy term invest the difference values, where they're trying to implement it themselves, all right, but they're doing it in a taxable environment, and on top of that, they have no additional benefits. So you can see here again taking loans and then paying them back just at just paying back the principal. Well, of course, we know that's not going to get them anywhere. They're gonna lose out on the interest they would have earned, and they're going to go backwards when they take those loans. So after 30 years, they have, instead of the 685, if they had not touched the money, they're taking it out and just paying it back, whatever they took. And so they're losing out on that 2% interest they were going to earn. If they take it out and pay back at 5%, they're going to do a little better. If they take it out and then pay themselves back at 10%, they're doing better. They're at 708, but we're still over $100,000 higher than them because we're compounding in an income tax-free environment. And they also do not have the additional benefits of the $1.4 million death benefit that is guaranteed to continue to grow and go to their heirs income tax-free. They can accelerate that benefit if they get sick, which you're, I think, 10 times more likely to become disabled before age 65 than to die. So that's a real benefit to help bolster their overall financial plan, protect them from those unforeseen things and those things that they have no control over. Getting sick, inflation, taxes, many of the other things that we are at risk of when we're just doing buy term and invest the difference. All right, so how does it work? Does the policy grow from loan activity? Well, as I showed you in the illustrations, the guaranteed cash value growth occurs whether there is a loan or not. So guaranteed cash value is not touched. The loan repayments based on a rate in excess of MTL's policy loan rate will add additional growth to the policy. So just a clarification there. Our guaranteed rate is 4%. Direct recognition has no impact on our guaranteed rate. It only has an impact on the dividend, okay? And as you saw, it was minimal after 30 years. So the important thing, though, is 4 percentage points, which is the vast majority of where all of that cash value is coming from. It's that guaranteed rate. That's not touched. It has no impact. Whether you take a loan or not, it's going to be exactly the same cash value and death benefit based on the guaranteed rates. And that pretty much sums it up. I know that's a lot to take in. There's a lot of information and thought behind what I've told you, so I know that it can be confusing, but if you have any questions, I'd be happy to answer.
Okay, looks like we do have some in the question box here. This one comes from Ron. He says, do you have a plan or concept for younger people starting their careers who do not have large amounts to invest?
We do. We have a guaranteed purchase option. So if you have individuals who they haven't, maybe they just started working, maybe it's a policy that's even being purchased for them by their parents and they're even younger, you can add a guaranteed purchase option to the contract, and that allows them to buy additional amounts of life insurance as they get older and have a baby, or get married and have a baby and buy a house and buy a car or whatever. And you can purchase an additional $350,000 in total over the course of their lifetime up to age 40. The other thing you can do is you can add a paid up additions rider, as I mentioned before, that allows them to fund at a lower level on a base with a lower base premium. And then as maybe they get an increase in their income, want to contribute more to their policy, that paid up additions rider can take that money. And we can design it to take a substantial amount. Again, the contractual limit is on $100,000. But it builds a lot of variability in. As far as other sales concepts regarding younger individuals, we do a lot with college planning. And then maybe Mark will want to hit on that a little bit, but we do a lot with college planning where you can design policies to take cash value, and what that does is actually hide it from the schools and the FAFSA. It doesn't show up on the FAFSA, the financial aid form. So it can put you in a better position regarding loan rates and tuition offers even. So there are other concepts that we have talked about, and we can talk about again in the future.
Yeah, in fact, Kip, I actually did bring that up before earlier on. I think you weren't on yet. I did mention that. So, and talked about the training we're going to have here next week. So,
okay.
Randall is asking. He says it's still a little unclear about how the net interest is determined.
Net interest. So if you're talking about two different things there, maybe. So let's break it down again. So, okay, you have your cash value. Our loan rate is 5% if you take a loan on the cash value. I wouldn't think of it as in terms, I know this is common to do and everybody likes to do it. Think of what you're earning in the contract versus what you're paying on a loan, and that's your net interest rate. That's what you're really giving up. But it's really not, I mean, that's accurate, but here's a different way to think about it. If you had a savings account and it's earning 5%, what you could do is you could pledge that as collateral. And you pledge it as collateral and you take a loan, and let's say your loan is 7%. Most of the time you wouldn't think, what's my net loan rate? It's not 2%. Your loan rate is 7%. That's what your loan rate is. So it's good to I think it's kind of good to separate the two. What's the loan rate versus what you're earning in the contract. But there is that. So you have the loan rate, and yes, you are earning guaranteed 4% in the contract plus the dividend. So if you just looked at the guarantees in the contract and what that rate is, it's 4%. You're taking a loan at 5%. Your net is 1 percentage point. Okay. Now, on top of that, you're earning dividends. So when you take a loan, we apply a recognition factor to the dividend portion of the money that you're earning in the contract. And that is a factor that we use and we calculate it based on the average loan outstanding over the course of a year. It's 0.007. So if you have an average loan outstanding over the course of the year of $10,000, we're going to multiply that times 0.007, and it's $70, and we're going to subtract that $70 from whatever your dividend would have been. So your dividend may have added an additional 1.5 percentage points. In this case, maybe it's only going to add 1.4 percentage points. So there's two components there, and I know it's kind of confusing. There's the interest that you're earning on the guarantees, and then there's the dividend on top of that. The point is, when you factor all that stuff in together, your net spread is generally going to be anywhere, when you add the dividend in, it's going to be anywhere from a net difference of 1 point or less. Okay, a lot of words in there. Sorry. Did that help at all?
I guess we'll see if he replies back. So
feel free to say what.
Yeah. So Roger asked, if someone is uninsurable, this is a good question. Can the policy be someone else, maybe a child, but will still work?
It's difficult. It gets more difficult with children because of the limits on the amounts we can put on them. Generally, children can get about half of whatever the least insured parent has in coverage. So it tends to put limitations on what we can do. If you have several children, you can do it that way. Sometimes might make that work, but generally speaking, you want an adult. It just seems to work better.
Yep. Kip, I have a question.
Yeah.
Is that your grade school picture?
That is me, and there's my crush sitting in the background.
There you go.
I ended up marrying her. That's real life.
Oh, that's good. Folks, the question box is empty, so if you have any other questions, go ahead and type those in real quick. We take advantage of Kip's expertise while he's on the phone here this morning. And while you're doing that, of course, you can call Kip's phone number there, or you can call our number, which is 800-255-5055, and we can certainly work on putting together a case for you. Roger asked, what age is the top side of this idea?
Oh, that's a good question. That's not an easy question. I would say depends on the circumstances. I'd say once you get into your 60s, it starts to get difficult. Mid to late 60s, I think that's your top.
Yeah.
Again, it depends on design, but I mean, if you get to that age where you're you're looking at mid to late 60s. You can still do it, but it's going to require lump sums of money to go in. So sizable premium.
Yeah, the mortality is not in their favor at that point, is it?
Exactly. I mean, it's so costly. And not to say we couldn't do something, but infinite banking, that's probably not going to be the answer.
Yeah, that's true.
And again, we do have, I don't know if you mentioned this before I was on, but our conference is fantastic. We call it our Vanguard Conference. And we're going to Sydney, Australia next year. And the ability to get there is very, very reasonable. Our qualifications for first-year agents who sign up through IMES, the requirement is $30,000 in NBC. We calculate NBC as 52.5% times base premium, or target if you're used to UL speak. And so if you did, over the course of a year, $60,000 in base premium, that would get you out of Australia. However, if in the first 4 months, we double the credit. So instead of 52.5, it's 105% of base premium. So that means you could get to Sydney, Australia, if you did all the qualifying business in the first 4 months, you could get there with $30,000 of base premium. So I mean, it's very reasonable. On top of that, we even let you watch a series of videos on MTL University that talks about some of these concepts, like infinite banking and LEAP and others, and college planning. You watch 6 videos, we'll give you $2,500 in credit. So now for $26,000 and change, production, you can go to Sydney, Australia next year. So I think it's a fantastic opportunity, and you can double up on your credits and qualify for IME's fantastic trip as well. So you get a double bonus.
Absolutely.
So I just want to make sure I got that in.
Yeah, I appreciate that. I did talk about our trip, and yeah, you can actually qualify for both on the same premium. And I tell you, I've been fortunate to be on a lot of company trips, not only as a producer and agent advisor myself, but also from the IMO standpoint. And we just came back from Hawaii. What's that? About a month ago, Kip.
Yep.
And you know what? Mutual Trust Life really does it right. It was such a great trip, a lot of great hosted events, and there's really no meetings to speak of. So if you want to go and have a good time, just a great group of people too. So looks like we got another question popped up. Roger says,
sure.
Why doesn't Social Security system work this idea? The government could keep the death benefit and pay off some of the debt. Plus the person could get his income benefits. That's a good question.
Well, we're talking about the government. I think that's the first and last thing we have to say.
Yep, exactly. We'll just leave that one on its own, right?
Yeah.
Okay. Well, Kip, it looks like our question box is empty. I appreciate you taking time here this morning to help us out. And, folks, again, I can't tell you how much we appreciate you taking time to join us this morning. You can certainly call the number on the screen here, and we can help you get set up to start taking advantage of this opportunity. And again, the college planning is another thing. If you're interested in that, we can certainly get you set up there too. So thank you all for joining us. I'll send out the recording here. Should be by the end of the day. If not, it'll be first thing in the morning. And then I'll be following up with a phone call here as well to see if there's something we can do to help you get set up. So have a great day. Look forward to talking to you all soon.
Thanks, everybody. Take care.